Welcome to Bloomberg Markets. I'm Shonali Bassick. Let's get a check on these markets because it's a tough day. You're looking at the S&P 500 now down about 1.4% and an even bigger sell-off in the NASDAQ 100 to the tune of 2.4%. If you look at the week, the S&P 500 is down about half as much of what you saw last week, really wiped out of that post-election rally. The two-year yield now at 4.30, the 10-year yield now at 4.43, but we have been hovering around 4.5%, a little bit of volatility, but right now we are flat. Now, also remember, JP Morgan CEO Jamie Dimon spoke at the APEC CEO Summit in Lima this week, and he noted about how many banks are seeing the opportunity in deregulation that could happen under a second Trump administration, and how excited those bankers are for that moment.
Whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit, and so and you could have kept the banks equally safe, but had them do more credit. And so, to just give you an example, the average bank in America, I think the number is, used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans.
We're going to talk about the banks, the Trump economic policy, and more with Guggenheim Securities Co-Chair Jim Millstein, who was the Treasury Department's chief restructuring officer under President Barack Obama in the wake of the 2008 financial crisis. A great person to talk about regulation. But I've got to ask, as Jamie Dimon says, are your bankers dancing in the streets?
Well, I think, you saw the rally after the election in the equity markets. That's getting a little more muted now as reality sets in. But yeah, I think there's a general expectation that the M&A environment will open up. The financing markets have been incredibly strong. So, I think there's no lack of credit availability, notwithstanding what Jamie says about the banks. The private credit markets have boomed in the last 10 years. So credit availability remains very strong. You can see that in the tight spreads in the high yield market and in the investment grade market. But yes, on the M&A side, I think there's a sense among most investment bankers that there should be a freer regulatory environment to try and get deals done.
Probably one of the clearest trades you have seen is in the financial system, in the banks. You've seen investors pour a lot of money into banks, thinking that not only that Basel III might not be as strong as it would have otherwise been, but you think about even Sherrod Brown, not in the Senate Banking Committee anymore, for example, or the SEC facing some change under a Trump administration. How significant, Jim, might the rollbacks in regulation be for the financial industry? Yeah,
so it depends. It depends who's in the seats. We still don't know who's going to be at OCC, the FDIC, the FHFA, the CFPB, the Treasury Department. These are all still open seats. So, and the people matter, right? That's first and foremost. The second thing is particularly with regard to the banks, the regulatory system is quite complex with overlapping jurisdiction of different federal agencies. So to actually have a relaxation of the regulatory constraints under which they currently operate, there has to be coordination among various federal agencies. And so it takes time. It'll take time.
Do you think that there is a paradigm shift going on? You think about just a whole generation of bankers that were not working in the 2008 run-up. They don't remember what it looked like, the froth under the surface. Do you think that deregulation could create that froth again?
Well, it may be true in the financial institutions that there are few of us left who were there and went through that trauma, but it's not true in the regulatory community. Now, there could be a wholesale slaughter of regulators at all levels under the Trump administration. I doubt it. And as a result, the regulatory institutions, the Fed, the Treasury Department, the OCC, have deep institutional memory. So I think there's still the experience of that crisis it's muted now over time, but I think people understand that we don't want to get so deregulated as to create risks of that kind of crisis again.
Now, let's switch gears a little bit, go over from the tempering of regulation to the trade and tariff policies that have been put forward. When you think about the entirety of what has been proposed during the campaign, do you expect moves that drastic into next year?
Look, we don't, we've had campaign proposals and which ones of those turn into real policy and legislation, still remains an open question. But, the president-elect has made a commitment to use tariffs as a negotiating tool to bring tariff barriers that we face down. But there are the China relationship is entirely different. That's I think a strategic choice to use tariffs to try to onshore critical industries back to the United States, critical defense industries back to the United States. I expect on the tariffs that, President Trump will use them vis-a-vis the rest of the world, Europe and our other allies. He'll use those in a way to try to create reciprocity, better reciprocity. With China, I think it's a totally different story. I think there's using tariffs as part of a strategic agenda to improve our defense capacities.
What do you make of the impact for investors? I had this conversation earlier this week with Citigroup CEO Jane Fraser. She made the point that, yes, you could worry about inflation, but that productivity could fill in some of that gap, that it might not be as big of a problem as a lot of people had initially pointed out. What do you make of that argument?
Well, I think that's what we're seeing right now, right? I mean, notwithstanding sort of the campaign rhetoric, the economy is incredibly strong. It's growing above trend. Productivity is the highest it's been in 10 years. So we've had a real surge of productivity. We have low unemployment. I think and yet inflation kind of remains sticky, particularly in the housing market, which takes time for rents to roll over in the way the Fed calculates house price inflation. But I think most Americans experience housing as a real constraint on their cost of living. And so, I think the inflation risk remains strong, both in prospect for what the Trump administration may do on tariffs, on deportation, which will create constraints in the labor market, and with regard to the federal deficits. Trump's a big spender, and he ran up deficits during his first term, putting aside COVID, which was a bipartisan effort that resulted in a huge increase in deficits. And the deficits are coming down, but they're still huge. We're still running a 6% of GDP deficit, which is unprecedented in peacetime. So the fiscal space that the new administration has to maneuver is much more constrained than it was when he took office in 2017.
You have seen the 10-year really react to this idea. You've seen it hovering around 4.5%. What would you warn investors about where it could go?
Yeah, I think I don't think it's going to go down much because of the Treasury Department to refund the outstanding debt, which has a relatively short maturity profile, and to fund the deficits this year. The Treasury Department is going to have to do $8 trillion of financing. So pity the new Treasury Secretary. The first job is going to be to figure out, is he selling coupons? Is he selling bills? What's he doing to try to moderate the impact of the deficit, and let alone what incremental deficits the Trump administration might create from tax cuts. So I do think, I don't doubt the depth of the Treasury market, but it's a question of the price the Treasury Department will have to pay for Treasuries when they're issuing $8 trillion of it this year. And, as important as short-term rates are, which the Fed controls, real money investors look to the 10-year as their benchmark. And so, a 10-year that stays where it is or gets higher because of the clearing price required to sell $8 trillion worth of debt, that's going to affect equity valuations for sure.
At what point does the bond market say no more?
I think we're a long way from that. I think it's about price. and creating a positive slope in the curve so people can borrow short to fund long, which is how many hedge funds play in the Treasury market, and they're an important factor in the Treasury market. So I don't think it's a question now of no mas. I think it's really a question of price, and but the federal government has been running persistent deficits that have been growing for 20 years.
That's what I was going to ask you. You and I have talked a lot about the deficit, and the idea of it getting bigger, it's been financed, right? I mean, at what point does this become a problem? How do you reframe the problem going into next year, thinking about those tax cuts?
Yeah,
What's the problem?
Well, look, since the financial crisis, the federal debt to GDP ratio has gone from like 50% to 120%. So we're growing the debt faster than we're growing the economy. So the debt is, and there are arguments among more sophisticated people than I, that the overhang of debt becomes a constraint on growth, in part because the interest burden that the federal government, we're now spending $1 trillion on interest. It's becoming the largest part of the federal budget. And when you think about what the federal government does, we have a mixed economy where the government constitutes about 20 to 25% of GDP, federal spending does. And that federal spending can have a huge impact on whether the economy grows or not. I believe that the Biden administration doesn't get enough credit for the public investments it's made through the infrastructure bill, the CHIPS Act, the energy transition bill, so-called IRA. That spurred a huge amount of private investment side by side the public. And that private investment has driven productivity increases and economic growth. Mm-hmm. But, as the deficit grows and the debt ratio increases, it starts to really crowd out the public investments that the government can make and private investment.
So I want to switch gears here a little bit because your expertise is of course, in bankruptcies. Kind of leads me into doomsday conversations with you sometimes. But when you think about AI and the productivity boom that a lot of people are expecting, I'm actually wondering about just the opposite. If you think about how AI is changing industries, is it going to create a different type of bankruptcy wave for companies that can't keep up?
Well, I think the challenge of AI, first and foremost, across our industry, across law, accounting, I think those are the areas where you're going to see the most dramatic changes, because those are the areas where productivity is stalled over the last 20 years. It's hard to make a banker more productive, but AI will do that. It's hard to make a lawyer more productive, but AI will do that. So I think you're going to see a huge transformation in the professional services business very quickly. I think it's already having an impact.
How is AI going to make a banker more productive?
Well, there's a lot of work that that's behind the deal maker, that goes to the evaluation of strategy, tactics, and valuation. And a lot of that valuation work can be done with these large language models. And the same thing's true in the law and in accounting. So I think, but going back to your question about the transformation required, I think businesses across the board are going to have to pivot and take advantage of these new tools. And if they don't, they're going to find themselves on the wrong end of the stick in competition with people who do. And I think this is a very transformative technology. The productivity impacts of it will probably lag, but there will be substantial.
Jim, we have to leave it there. It's so great to see you here in studio. That is Jim Millstein, of course, Guggenheim Securities Co-Chair. And coming up, Pfizer and other vaccine makers are falling after President Trump announced his plans for RFK Jr. in the next administration. We're going to dig into that next. This is Bloomberg. The This is Bloomberg Markets, and I'm Sonali Basak. It's time now for the stock of the hour. We're watching vaccine makers Pfizer, Moderna, BioNTech, and Novavax all trading lower after President-elect Donald Trump said he was tapping prominent vaccine skeptic Robert F. Kennedy Jr. to lead the Department of Health and Human Services. For more on this, we're joined by Bloomberg's Madison Muller, who has been covering RFK Jr., covers the healthcare industry for us here at Bloomberg News. You know, when you think about this nominee, it's a nominee. It still needs to meet confirmation. You are seeing a pretty significant reaction here in the stocks. How does that conflict for investors who are so excited, as you were saying to me before, about the pharma industry under President-elect Trump?
Right, exactly. It's kind of a reversal of the trend that we saw after Donald Trump, came ahead in the polls and won the election last week. Or 2 weeks ago. I'm like losing my mind now. But there was enthusiasm that M&A would pick up, that Trump would be better for the economy overall, which would be good for healthcare, would be good for pharma. And now with this pick or this nominee of RFK Jr., that throws that into for a little bit of a flux because he has been really critical about vaccines. He's walked back some of that criticism more recently and has said that he's not going to do away with vaccines entirely, but he wants more information and wants the studies to be more accessible, wants more studies done on safety, and has been, for years, this isn't a recent thing, for decades, he has been quite critical of vaccines. He, has said that he doesn't want the corrupt influence of pharmaceutical companies and big food in government. That's like one of the statements that he's made quite a bit. He is somewhat anti-big pharma and anti-using medications and drugs to sort of fix American healthcare and chronic disease. So that is one of the things that we're seeing now. We don't know what that will look like in terms of policy quite yet, but it has obviously affected the drug maker stocks today.
Yeah, let's talk more about the companies themselves, because on a closing basis, at the very least, you're seeing Pfizer stock down the most since December. It's pretty significant. So who are the biggest losers in this scenario from a corporate perspective?
Yeah, I mean, one of the big things, obviously, are vaccines, as we were just talking about. So Pfizer, BioNTech, Moderna, Novavax, some of these companies that are the big vaccine makers. But RFK has also been critical of Ozempic, so we could see, and Novo Nordisk in particular. He's had some tweets about Ozempic and mentioned Novo Nordisk. So that's something that we could see down the line. But, it's interesting. He's also, on the flip side of that, there was an op-ed that he wrote in the Wall Street Journal a couple months ago where he said, he's in support of lowering the price of drugs, and named Ozempic as an example because, as we know and have talked about, it's more expensive in the United States than it is in other countries. So we don't really know what's going to happen yet. He's, said he's supportive of lowering drug prices, but then has said that he doesn't want us to rely on medications like Ozempic. So we kind of have to wait to see what will happen.
What are your sources saying? What was the initial reaction from the pharma community to this appointment?
Yeah, I think people are careful about what they're saying right now, and there was definitely some surprise. Definitely some worry. Even talking to sources prior to this announcement, there was a little bit of, I think, disbelief that he would actually be the nominee for this position because of, one, his lack of healthcare experience. He doesn't have a medical degree, isn't a scientist, isn't a researcher, doesn't have that background. But two, because of the very firm anti-vaccine stance that he's had, a lot of these drug makers just didn't really think that he would be in this post compared to the first Trump administration, where there were more sort of reasonable or expected picks for these positions. And so it was a little bit of a surprise, and now they're trying to figure out what it really means for them.
And I know you'll bring us all of the implications as we get to know them. That is Bloomberg's Madison Muller, of course, covering healthcare for us here at Bloomberg. And coming up, we're going to talk about electric vehicles instead. EV stocks are sputtering after reports that $7,500 federal tax credits could end when Trump returns to Washington. We're going to hear from the CEO of Lucid next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. Today, we're taking a closer look at the EV maker Lucid. Shares are falling after a report that President-elect Trump, will try to end federal EV tax credits. Lucid Motors CEO Peter Rawlinson spoke earlier to Bloomberg about what a second Trump administration means for the company.
I think he's a fan, like so many, of American innovation. And what better example of American ingenuity and innovation than Lucid Motors, the most advanced tech in the world. And I think America is truly blessed with the technology and the technology advantage it has in the EV space right now. And I think that we need to think of the jobs that are created as a consequence of this, great high-tech jobs in Middle America. And any incentive is truly an investment in the future American economy and jobs creation. So I think we should be cognizant of that. But I also would like to state this, that because Lucid's got the most advanced EV technology on the planet, we're able to go further with less batteries. So if there was a situation where incentives were removed, which incentivize the amount of batteries you put in the car, Lucid, amongst all the EV makers, is really the most immune from that.
What do you make of the relationship between the president-elect and Elon Musk? Do you ever worry that perhaps Tesla could get more favorable treatment?
I am eternally optimistic that Lucid will prevail because we are a tech company and we've really taken the mantle of technology leadership from Tesla right now.
Of course, that was the CEO of Lucid Motors speaking today. Of course, his stock, his industry facing some pressure. The broader markets also facing pressure. The S&P 500 down about 1.5%, and the NASDAQ 100 still down further, 2.5% lower. But of course, that does it for Bloomberg Markets today. I'm Sonali Basak. Have a great weekend. This is Bloomberg.